as of today, but Monday was not the best day of my life. Let me just
Do
put
you
it
think
that
dips
way.
are buying opportunity?
Well, that's the interesting thing. I think it is, but it doesn't mean that gold's going to rocket back up to 1,800 anytime soon. I think what you got to do is you've got to, if you don't have any gold now, it's a great time to start. I mean, you've just got a 15% discount. But I wouldn't buy it all now. I'd buy half of it now, and then over the next 5 months, I'd buy 1/5 every month for the next 5 months. Kind of dollar cost average into, because when you have a panic like you had over the last week, ultimately it's going to be seen as a great buying opportunity. But that panic may last for it was a hell of a move. That can bleed over into markets for the next couple of weeks, next couple of months. But by the end of the year, I think we're much higher. By next year, I think we're much higher. And certainly 5 years down the road, we're much higher. And that's where I think you got to think of your overall portfolio. And so I know that today's conversation is kind of really centered around the monetary system and gold. But I think it's much more than that. There's another sheet in here. I'm going to kind of wrap it up on this. Or how much time do we have?
What do we need?
Where's it at? Sorry. This sheet here I think is important to look at. So this is kind of what we've come up with, like 6 different possibilities of what could happen in the years ahead. And gold is only one part of this. So, we could have a full recovery, go back to how things were, and everybody's living good, and markets are rising, no worries. In that case, maybe gold goes down. Real estate does well, bonds do well, stocks do well. We could continue to muddle through the same way we have for, call it, the last 4 or 5 years. In the last 4 or 5 years, the market's gone up, the stock market has gone up, but that's about the only thing that's gotten better. And to me, that's a signal in itself. If the stock market's gotten better, but nothing else has really gotten that much better, that's a sign that something's not quite right. And you can debate what it is that's not right, but that in itself, to me, is something wrong. We could go back through another 2008 recession or depression type event, in which case basically everything goes down except for gold and bonds. Where we think we're heading is the bottom left-hand corner, which is an inflationary recession. Hopefully we won't go through a total monetary system collapse, but I wouldn't take that off the table either. But essentially, we think that the governments are doing everything they can to prevent a deflationary recession or a recession with sovereign defaults, which is kind of what's going on in Europe right now. So they're pushing us towards this inflationary recession. That's what the Fed wants. The Fed would love nothing more than to get 5% inflation for the next 10 years. Because if they do that, it takes away 50% of the debt. Take 5% times 10, 50%, it makes the debt 50% easier to pay off. So the problem is it's very tough to get 5% inflation and just hold it there without having a lot of, again, unintended consequences. So we think you got to be prepared for any of these 6. And if you're prepared for any of those 6 and you have a tactical strategy, again, we don't believe in just static asset allocation. You should have exposure to all these areas, but you shouldn't be married to any of them. The only one I would get married to right now is gold. Because of the math is just so outlandish. I just don't think we can get our way out of this with either very high inflation or a collapse.
What does it mean on an asset class that you have both up and down arrows?
So, that's a good question. So like in the muddle through, it just means stocks are up a little bit, bonds are down a little bit. But like over here, in 2008, gold went down initially, but then it spiked back up quicker than everything else. Here in the middle, we've got bonds. So with sovereign defaults, I'm saying like corporate bonds may do very well, but the bonds of Italy, Spain, Greece, they've done very bad. So the sovereign bonds here have done poorly, but a bond.
So it means either it's a trading range or it's a some stratification of the class into a smaller.
Yeah.
When you say bonds, do you mean?
Government bonds, right?
No.
Well, it could be kind of all, and that's this is
Pricing.
probably needs to go into a lot more detail. I was just trying to get something kind of from a high level, but bonds could be from IBM, from GE, from Google,
Corporate bonds.
or it could be from the United States, Canada, Mexico, Russia.
Because it's kind of interesting when I was listening to something a couple of weeks ago when they were talking about the bankruptcy of Stockton, which is just one little medium-sized city. The powers that be would not budge on the big pension liabilities, the public sector pension liabilities, and they ended up pointing to the municipal bonds that Stockton held, which means that they would not pay on the bonds and the
Right.
bond values would collapse.
Right.
And they're stating that off. It's not in the news very much, but if I read tea leaves correctly, if they do that, because of the democratically held legislature and the public sector unions, that has a very bad implication for all the municipal bonds across the country, which is a huge sector of the bond market.
That's what the judge did, by the way.
Oh, he did in fact do that. I didn't hear the follow-up on
Well, so that's where that's kind of where we get into the whole tactical thing, because for the last 30 years, the bedrock of high net worth or retirees portfolios has been their bond portfolio. You put 40, 50, 60% of your portfolio in municipal bonds, and you reap that tax-free income, and they never default, and it's no problem. But interest rates are now at an all-time low. They really can't go any lower. So they might not move for a long time, but when they move, there's only one way for them to go, and that's up. And that is not good for bond prices. Not only that, but as Stockton is a good example, a lot of these municipalities cannot afford to pay the bills that they have. They just can't. At some point, it all comes down to cash flow. If you don't have the cash flow to pay on the bonds, it's a default. Whether you're supposed to default or not, if you can't pay on the interest payment, it's a default. Now, if California was the U.S. government, we would just print our own currency and buy the bonds ourselves. But California doesn't have the ability to do that. So either the government's going to have to come in and buy the bonds, or they're going to have to default, or But it's a big problem. I think it's going to be a bigger problem in the years ahead. So to the extent that you have large bond portfolios, I'd encourage you to take a second look at them and really kind of try to understand how much risk you actually have in your portfolio, because I think there's a lot of people out there who think they don't have a lot of risk in their portfolio, but in fact do have a lot of risk in their portfolio.
In your experience, how fast do bonds depreciate if they go south? Is it like the stock market, or is
It can be. As an example, if you've got a bond with a 10-year duration, as an example, and interest rates go up 1%, I think that can have like the bond can go down 5-10% depending on where it is in the.
Yeah, but it's not like a stock market, correct?
No, it's not. It's not typically like that. But if you get interest rates spiking a lot, they can go down very quickly. So.
But you still can hold to the full 10 years.
Sure.
Full
Yeah, sure.
dollar.
As long as that city or that company is still around 10 years when it.
California and GO bonds should be safe because they're supposed to by the laws, they're supposed to pay the GO bonds first before they pay the
Sure.
rest.
But the people in Cyprus are supposed to get their money out of their savings accounts too, but they didn't get it.
Well, I think what's going to happen in the U.S. is some states will default, but what's going to happen? They're just going to roll it up to the federal level,
That's
right?
right.
Yeah.
And that'll just exacerbate the federal problem, right?
I mean, the other thing is I should come. I'm actually a pretty positive person. I know I'm coming across as doom and gloom.
Gotta go
and
back to
head full of
the
hills.
hills.
We'd hate to see you on a bad day.
Yeah.
So,
And believe me, my wife calls me Pigpen because I walk around with a cloud above my head all the time. But
one question.
Yeah.
How does this monetary stuff work when everybody else is inflating their currencies as well?
Oh, yeah, good
The other
question.
country is doing that. So,
So your story was mostly an intra-U.S., but I mean,
Yeah.
Japan, ECB's doing it kind of indirectly.
if everybody's devaluing their currency, then,
and I would argue that's part of the reason why the U.S. dollar. That's why part of the reason why we haven't had as much inflation yet is on a relative basis we look pretty good. Japan is printing more. The ECB until recently has been printing more.
Race to the bottom.
As bad as the debt situation is in the United States, it's even worse in Europe. It's horrible in Japan. Japan's unbelievable. I feel bad for those people.
Yeah, it's 200% of their GDP.
Yeah, I mean it's crazy. I mean,
Yeah.
So why haven't they, they would seem to be a great canary in the coal mine, but they don't, of course, the Asian culture is a little different. They have a much higher savings rate than the Americans, and
I think
the
that's
vast
not
majority of
Japan.
Japanese bonds are actually owned by Japanese, not,
so right now,
but they would stand, they've been doing this for over 10 years, right?
Absolutely.
Printing money.
there's been so many. It's kind of they call it the
Yeah,
widowmaker.
yeah.
On Wall Street, they call it the widowmaker because so many like big name people have tried to short the Japanese bond market and make a big name for themselves, and they've gotten killed.
Right.
and they've
So
lost a lot of money doing it.
How does that fact fit
Well,
into your
Because
thesis?
if you look at the demographics of Japan now, there's more people retiring than entering the workplace.
Right.
They're old.
There's more adult diapers sold in Japan than baby diapers sold in Japan. That is a fact.
Now, do they still buy beer with the diapers?
That's,
If,
that's called fundamental
Let
analysis.
me- I'm trying to think of the, okay, they have, their budget deficit is,
They have a lot of old-
I think
I don't remember the exact number, but if interest rates go up 1%, it takes up more than half of their entire tax revenues.
Yeah.
Because interest rates are zero, essentially zero.
Right.
So if interest rates even go up 1%, it totally wipes out
And their
tax revenue.
GDP ratio
I mean,
is highest in the
yeah,
developed world.
yeah. And again, it can stay at zero for a very long time, but when it moves, it's going to completely wipe out their tax revenue. Completely.
Well, the same thing happens in the US, right?
Yeah,
They're not gonna be paying,
Exactly. So I think what you got to do, at the end of the day, what you've got to do, you've got to prepare for all eventualities. It's possible that I'm wrong, so don't do everything that I say. Have some equities, have some, corporate bonds, have some, but don't just sit there blindly and think it's all going to be okay, because I don't think it's going to be okay. I think it's going to be very bad.
of your money that's not in this thesis here, what is your other money doing?
Cash.
That's it?
I think no, I have a little, well, plus I've worked in the stock market, so just by nature. I mean, I think you got to consider your own situation, right? If you work in the software industry, you shouldn't have a portfolio full of software stocks, because you're already exposed to it. Or you should have other things besides software stocks in your portfolio. My biggest asset is my job, so I'm totally exposed to the markets. So I don't need to have as much exposure to stocks as somebody who has no exposure to the stock market. That's why I have a few equities, but my two biggest positions are gold and cash. I think everybody's second biggest position should be either cash or very short-term bonds. And it sounds kind of opposite of what I'm saying because I'm a big dollar bear. But in the short term, the world operates on dollars. Now, it's not always going to operate on dollars. And I think that end is going to come sooner than most people think it is. But in the meantime, you need dollars to operate. Not only that, but if you have cash, when you go through in a period like last week with gold, it makes it easier to withstand.
Right.
The worst thing that people could have done last week is panic and just start selling everything. If you have cash, it keeps you from panicking because you understand that markets ebb and flow and there's going to be moves in and out. But there's got to be a portion of your portfolio that you think of for the next 3 months. There's got to be a portion of your portfolio that you look at for the next year to 2 years. There's got to be a portion of your portfolio that you think of for the next 5 years. And there's got to be a portion of your portfolio to think of the next 10 or 15 years. So you shouldn't just diversify by asset class. You should diversify by geography. You should diversify by currency. You should diversify by time or duration, which is kind of what I was just getting at. But there's got to be some portion in there that you should look down the road 10, 15 years. What's the world going to look like in 10 or 15 years? Are interest rates still going to be at zero in 10 or 15 years? Are we going to have amassed more debt over that 10 or 15 years? Is our debt situation going to be better in 10 or 15 years? If you think so, then don't buy any insurance. But if you can see the trend and you realize what's coming, put a portion of your portfolio away that's going to reward you 5, 10 years down the road.
What about going to gold as a subset of a larger thing, which is commodities? What about
Sure.
other commodities?
Absolutely.
I mean, that would seem to be all
Yeah.
following a similar reaction.
Commodities
pattern.
is a great way because if you think the economy is getting better, then there should be nothing better than commodities. Everything, because everything we make is commodities, right? So if you think the economy is going to improve and we're going to sell more houses and more cars and go on more vacations and buy more clothes, well, cotton is what clothes are made out of. You need oil to get to wherever you're going on your vacation. You're going to buy more houses, well, that's made out of wood and copper gets
So
wired
what
into it.
commodities do you like other than precious metals?
Well, short term,
Classes of commodity.
Yeah, agriculturals probably, because people are always going to need to eat.
Right.
So, and it doesn't need to mean you need to buy corn, maybe buy a fertilizer company that, is in the agriculture business, or Archer Daniels Minzload or something like that, that's a big commodity provider.
Okay, looking at a slightly different question.
Yes.
You take the balloon government debt and Willie Sutton principle, and the feds say, let's go after all these IRAs, KIOs, 401ks, and let's confiscate some of those and give federal pensions for those.
Yes.
Do you think that would spread to just regular brokerage accounts? And the other half of the
It
question
already
is,
has. It already has. MF Global went bankrupt 2 years ago. It's a big commodities futures trading company.
Okay.
Corzine. People got 30 or 40 cents. When you put your money in a brokerage account, those funds are supposed to be segregated from the company's money. So when the company uses cash for its operations, they're not supposed to use the customer's money. Well, in MF Global, they used the customer's money. Customers did not get their money back. They could have been in cash, they didn't get all their money back. They could have been in gold, they didn't get all their money back. Peregrine Financial is another one. A year ago, I know a guy personally that lost $800,000 in Peregrine. And he wasn't,
Ostensibly, that wasn't the government confiscating the money. That was
no, but it's the banking system confiscating it. I mean,
Yeah.
it is.
Didn't
I mean,
they,
you can wrap it up and call it what you want, but at the end of the day, that was your money and you didn't get it back.
Well, yeah, but that was a private.
yeah.
But what's the difference? I
Well,
mean,
didn't
it's supposed to be
Argentina-
segregated.
Didn't
It's supposed to be
Argentina
segregated.
take the 401ks?
Yeah,
Or was it
twice.
Chile?
That's right.
I think twice.
Argentina.
Argentina? Yeah.
Yeah, they did it 10 years ago, and I think,
But how'd they do that? They just came in and said, hey, we're
And
gonna
they said
take
you
this
have to have
and
an
give you
investment
yeah.
in government bonds.
treasuries. We're gonna
Yeah.
swap your 401k
Yeah.
for
Right.
treasuries.
Or they roll it into the social security system.
Right, exactly, roll the Social Security, right.
So, are there signs so that?
Because they're doing it to help you. They're gonna help you manage your portfolio.
In view of the erratic
You
stock
are a
market.
funny man.
Well, actually, there was someone who proposed that in Congress.
Yeah, no, but this is-
Privatizing,
this-
I mean,
absolutely.
publicizing the 401k.
I mean, these are facts. In 1929, we confiscated the gold. The FDR confiscated the gold.
34.
I'm sorry, 31, maybe it's 31. 31.
34.
In 1939, the
33.
British government confiscated all privately owned investment securities to help pay for the war. That's a fact. Operation